Happy hunting out there. It's Andy Tuttle with the Tuttle Group at Cross Country, giving you another market update. Talk to you about a few things today. I know it's a crazy time, and I'm going to give you a couple updates what's going on in the economy, and then hopefully just give you some ideas and perspective on historically where we're at, and then maybe some things to consider when you are out there looking for a home now in this market versus just 6 months ago. So you're looking at the live trading of mortgage-backed securities. Most of you have seen this already from me. We've gone over it in our session, but this is a price chart. This is what all interest rates are tied to. Moves intraday, every day, just like the stock market does, right? So price chart means it's an inverted relationship. So the lower the price, the higher the rates, right? So if we go all the way back on the chart, you may have to move my little camera thing. Goes back to October, November of last year. Prices way up here. And then prices fell all the way down here, about 900 basis points. Rates doubled, basically went up 3% from where they were, which was around 3% at that time. Got as low as mid to high twos in earlier 2021, and then this is where we're at today. We've got a little short-term rally. So let's talk about a couple of things here and what to expect. If we look just from last month, prices fell. They were at 102.21 basically, went all the way down to 98, dropped over 400 basis points. So that's a spike of 0.5% in rate in just a couple of weeks, right? Since then, we have rallied back. We actually locked some of our clients that were able to get contracts here. We floated until they got here. That's what the benefit of time in the market, and one of the things that makes us unique is just understanding this stuff and watching it. We have since corrected a little bit from there. And we are resting. It looks like creating a new range. Okay, so even though rates spiked 0.5% here, we've got a lot of those gains back, about 0.25% of that back recently. So we'll watch where it goes here in the next couple of weeks. It is a very volatile market, and we're still in a bear market, right? So you always assume you're going to stay in that channel until you break out of it. And currently, with all of the resistance above us, we're hoping that we create a support line here and we can rest in this range and hopefully have a chance to test the top end of it. But we'll watch that for you closely. When you're out there looking for a home, regardless in this market, and looking at rates going higher, I think the MBA, Mortgage Bankers Association, came out with national rates around 5.9% with a point this week. Freddie Mac has some different numbers. Texas is, of course, a little different. You got about 0.25% or 3/8% higher rate in Texas than most of the rest of the country because of how we securitize, no state income tax, no sales tax on real estate, things like that. But generally, you can get an idea, rates are higher. So what do, right? Because prices are also up and things are up in the rest of your life. So I've been doing this 20 years, and one thing to remember is historical context. So going to this chart, it's important to know that and you can't get the most recent data. The best data I can get on a chart like this for you that you could also access, it goes to 2021. But that's where we got the lows, right? We were sub 3%. And right now, we're really in this mid-range here at about 6%. So we're testing these 2009 levels right now. But again, historically speaking, we are still in the low end of the range of the last 50 years of tracking this. And so we know that prices are up though, right? So it kind of counteracts that. Your buying power is reduced. There's no doubt about it. Here's some things to remember. If you're a renter right now, those stats just came out too, and you've got about a 15.6% increase in rents year over year, according to the Case-Shiller report, and a 1.6% increase this month. So it's on track for another 16% increase, right? And as those property taxes, those bills hit those landlords, they're going to keep increasing those rents. Versus a home, right? You can, file your homestead as a primary, and so you can put a cap on what they can increase those property taxes to. But also, it's weird to say this is good news, but there's always a silver lining. When you're in these rate environments, there's always a correction, right? Every 3 to 5 years, those interest rates cycle, right? You can actually see it on this chart too. Of course, there's the big correction, massive jump up. That's the Volcker shutting down the economy and Reaganomics and all that. And then that's a big correction, but we see spikes and reduction in rates, spike, reduction, right? There's valleys and peaks, okay? So after a spike, there's a correction, a spike, correction, right? In those 3 to 5 year cycles. So there's going to be an opportunity in the next few years to refinance at lower rates. In fact, in recessions, most of the time, I should overlay that chart maybe next time, recessions usually what always follows is rate reduction. And You're probably not going to think this is good news, but GDP just came out, official numbers for the first quarter, minus 1.6%. They were expecting a minus 1.5%. So since recession is 2 consecutive quarters of negative GDP growth, based on the numbers companies are already producing, we probably are in a recession right now, right? So that means in the next 12 to 24 months, you should expect to see some reduction in your interest rate. So what do you do? How do you manage this? Well, one, if you find the right home and it's for you, get it, okay? It's a beautiful thing about home ownership. You always still see the equity, you're paying towards a savings account, right? It's to your house, paying down the equity, right? And you don't have to worry about having your payments spike up every year because the landlord has to adjust, okay? And you have an opportunity to lower your rate and get into better terms later. So those are some things to consider. You just have to be careful with your budget and not overspend, and look at different ways to leverage more of the home loan and pay off some of that other higher interest rate, higher payment debt. And the same goes if you're selling a home. Remember, you just got a lot more equity out of your home than you expected. Many of you, multiple times more. So let's leverage that correctly too, and consider, instead of putting all that down into the new home, hold on to some of that money, okay? And that's what we're advising clients, and looking at those numbers right now, those debt planning strategies, talking with their financial advisors, but looking at also paying some of your higher interest rate, higher payment debt off, okay? And keeping some money earmarked to the extra, not free money, but hey, extra money you got than you were expecting from the sale of your home. Keep that in a side account and pull from that every month to help pay the difference in the payment you want, right, for that home, and the payment you have because of the rate environment that we're in, right? And then for most of our clients, just keeping some of that money aside, we're able to keep them in their budget and have them have enough money in that side account to pay their difference in mortgage payment for the next 5 to 10 years. That's plenty of time to see a cycle correction, okay? So don't be nervous as the short term right now. Don't think that it's just out of reach. Give us a call. Let's redo the numbers if we need to. We're doing those as fast as we can. It's just every time we turn around, rates are different and we got to redo those again. But you're working with great agents. They're going to help you. We're here to help. And if it doesn't make sense, no problem. Let us know. But I want to tell you that in these times that I've seen, we want to lean into those and remember to align your financial strategy with what's going on in the market. And right now, in inflationary and recessionary environments, that typically means that you want to leverage as much debt as possible, good debt, right? Which is a mortgage is good debt, right? Because it's tax beneficial, not as tax deductible as it was. But leverage that because in a recession, dollar becomes worth less. So the debt that you fix today at today's dollar value becomes cheaper to pay off with future dollars. In addition, because of the way recessions and interest rate cycles work, leveraging that and waiting to see, okay, what's going to happen? How do we make sure we got enough extra reserves for this storm? And then once the cycle finishes out, then decide, oh, you know what? I'm going to refinance, lower my rate, and then I am going to pay this big chunk to the mortgage and have that other payment, right? But keep liquidity. Banks don't care, right? I've just been in this business too long to know. I don't want to give them more control. I've seen it too many times from my clients. Keep control of your money, okay? And call me with questions on this. This is not financial advice. This is experience from clients and my own personal decisions and advice I give my family, right, on how to leverage this and how to make sure that we're being smart about it, still get the home we want, move to the area that we want, and use our mortgage as a financial instrument to help create wealth. Appreciate you. Sorry for the long video, but happy hunting out there. Stay safe, and we'll talk to you later.